Have you ever wondered what it looks like to buy and invest in rental real estate? Well, today's your day. We're going to be talking to one of Canada's largest private REITs in the country, and we're honored to have Greg Romundt here on the show today. Hey, welcome back to Money Match. It's Ian Ardill here. Today, I'm joined together with one of my favorite people to interview. It's the second time I've had the privilege of interviewing him, Greg Romundt. Greg, welcome to the show.
Thanks. Great to be here.
Greg, you are not just a pretty face. You are the CEO and Chief Investment Officer of the Centurion Asset Management. And you guys today, correct me if I'm wrong, manage the largest private REIT in the country. And as it relates to multi-residential, even on the public or publicly traded side, you are the second largest REIT in the country, and it's such an impressive offering. Thanks so much for being with us.
Thank you. Happy to be here.
My introduction to you was kind of fun. My father, who was my predecessor in this space, was somebody who was actively involved in various investments and looking more and more into alternative investments back in 2009. And 2009, 2010, we were talking about another comparable private REIT in the country that's done very, very well. And I went home and did a whole bunch of research. And at the time, I wasn't even in the space. And I found this really cool investment offering called Centurion. And I said, Dad, have you ever looked at these guys? And he drove down to your office at the time. And
yeah, I remember that.
Yeah, and it's been an incredible relationship. We've actually been our firm has been actively investing with you for 14 years.
Yeah,
and
that's right. It's a long time.
And one of the very first investors that invested with you guys, he still talks about it today. He says, Greg phoned me and thanked me for investing. I'm not sure if you're doing that still today.
It's pretty hard for me to get that today with about, I think, almost 40,000 investors, so that would be pretty difficult for me to actually accomplish without sacrificing on some other things.
But Greg, it's such a privilege to have such a long-standing and a very effective relationship with you. Wondering, for those that don't know the story, wondering if you can just give us a 2-minute kind of elevator pitch.
Sure.
Who are you and what is the Centurion REIT story?
Sure. So I founded Centurion in 2003. Born and raised in Toronto, but moved and lived around the world. Came back with my young family in 2003 from moving around. Started Centurion all with my own capital. Built it for a few years, and then recognized, well, I'd had friends and family who'd been asking to put some capital in, and I said, well, I'm already paying for managers and accountants and all that, so sure, might as well, that'll help amortize some of those costs over a larger base. And then quickly realized, well, having 5 investors is not that different than 50, because I'm still having to write a report, so it's better that 50 people write it. And it's just one of those things that kind of, I wouldn't say it was necessarily intentional, at least in the early days, but then, just kind of grew and grew, and we continue to expand the platform. And, really the financial crisis was the period of time where we really broke out, where, interest rates went to zero, and people were looking for products with return and a little bit of safety. And we were at the right place at the right time with a product I thought worked.
What an awesome story. What an incredible way of, the way I always joke around about it is, it's a way of buying rental real estate, participating in the market, getting a fair share of return of rental revenues, but no one phones me. Like, as an investor, no one phones me about leaky toilets related to my Centurion investment. So
we try to have a few, minimize the number of leaky toilets. But, put it in perspective, we literally have about 40,000 toilets too, right? 22,000 units, and, most units have two bathrooms. So we're, 30, like, I don't know the exact number off the top of my head. I'm sure somebody does, but it's between 35 and 40,000 toilets. So there's an entire science about preventing water from literally going down the drain.
It's and what a great news story, and related to, in terms of maximizing efficiencies, that I know that there's a huge kind of diatribe there as well. But before I dive into the actual investment in any kind of meaningful level, I'm wondering, Greg, you've always been excellent. And if any listener is listening to this that wants a greater detailed dive, Greg, you've done an awesome job of publishing white papers along the way. And so certainly I don't want to distract from that, those awesome resources, but wondering if you can give us a tertiary view of what do you see going on in the Canadian economy right now? There's a lot of headwinds, but where there's challenges, sometimes there's opportunity. And so I'm wondering if you can speak to that.
Well, I mean, we've been talking about it for 3 or 4 years now, about this supply-demand imbalance in the Canadian housing sector. How it stayed out of the papers for so long is kind of beyond me, but now everybody talks about it. And, federally, provincially, city, everyone's trying to do something about it. So I think in many respects, we've got this tailwind that, for us, from an investment point of view, is going to be a very good one. The challenge, unfortunately, for the country is I don't see any way that we build the amount of housing that's actually required, which commentators like I have said we probably need between $3 and $4 trillion of investment in the housing sector in the next 10 years. Other people have suggested similar numbers. But that amount of capital just does not exist. So, I think as a business, being able to position yourself into the stream, not having to fight the stream, is at least a very I feel good about it. Where not only I think we can earn good returns, but I think we can do something that the country dramatically needs to solve its number one problem.
It certainly, it certainly speaks to the challenge of the fact that it's not an easy one and done solution. The other thing that kind of compares or mixes with that is obviously interest rates. What do you see happening in the interest rate market? Do you think things are going to, come way back down to pandemic levels, or are you thinking that we're going to stay in, where interest rates are going to spike, or what are your thoughts there?
So, I've written about this for a while. I believe that the next decade is an inflationary one. For a whole bunch of reasons, but to summarize it in the shortest way possible, we've got a war in Ukraine, a very good example, right? So post the end of the Cold War, there was this view that the world was at peace and we'd have this the peace dividend, right? And Europe is certainly having to gear up, and Canada is having to gear up. And this is inflationary. If you think about, just mathematically, I've worked out, if we wanted to get back to where we would have been if we spent 2% of GDP or NATO commitment for the last 30 years, we'd need to spend roughly 3% per year of GDP to catch back up in 10 years. So where's that money come from? That has to be printed. If we think about deglobalization, which is the other big trend, we had 40 years of globalization, which was a disinflationary force, which is in the process of reversing itself, right? And you can see that playing out everywhere. I've talked about this now for 3 years. So if you think about, let's say we try and do this deglobalize in 10 years, and we don't go 100%, but we go back half the way. So you get 40 years of disinflation, tried to reverse halfway in 10. So that's going to be inflationary. The other thing that's inflationary is this idea of, like climate mitigation. So if you believe what the politicians say they believe, which is we've got to invest, X number of trillions of dollars, call it 3% of GDP for the next 30 years. So where's that money? That's got to get printed. So add all these things up. Now, this is excluding housing solution. So where's that money come from? It's got to be printed. And what we saw during COVID was the governments had no inclination to say, no, we're going to have some fiscal discipline here. We're not going to go crazy. We ran a gigantic deficit, and even the United States in its recovery, today it's still technically not in recession, is running 8% of GDP fiscal deficit. So I do think, look, with the amount of debt that the U.S. has, it's currently on pace at the end of this year to be running a $1.6 trillion in interest rate costs, and that's only accelerating. So the Fed, I think, is desperate, and the same thing with the Bank of Canada, to get inflation to a point where they can cut rates or they blow absolutely everything up. So rate cuts are coming. Exactly when, I don't know. Canada will have to cut deeper because we're already in a recession, right? If you look at GDP per person, we haven't moved in many years. In fact, we're declining in real GDP per person, right? So Canada's going to have to cut deeper. So to answer your question, whether we go back to pandemic lows, I don't think so. Probably because I think we need to have real interest rates negative again, because you cannot get to these levels of debt without, governments having to, okay, well, we need to get rid of that debt. And it almost never comes because of fiscal austerity. That's just not something that's in a politician's word vocabulary. So it will be one way or the other, the printing press that takes care of this.
It's pretty scary when you think about all of those moving parts. It kind of gives us a bit of a gloomy look at the prospects here in Canada. But I think the really positive news, if there is a silver lining, is I believe that there are certain asset managers, Centurion being one of them, that's done an awesome job at trying to position those of us who are investors in a positive way. Can you talk to me about how is it that you believe Centurion is kind of meeting some of those challenges?
Okay, so I think there's a couple of ways. And the first, I think in an investment thesis, I've been managing money now for almost 35 years. So one of my strategies, as much as I've been a trader, my style of investment has always been to get behind stories I have fundamental beliefs in, right? So I'm not the kind that's just like, well, number goes up, so I'm going to buy because everyone else is buying, and that's a trading strategy all on its own. And there's plenty of people who have made a lot of money doing that. My fundamental strategy is, which way is the wind blowing? That's going to blow for a consistent period of time, have real conviction about it, and then get behind that idea. So Canada clearly has a need for housing that's not going to go away. There is nothing, and this is an entire whole conversation, there is nothing that can or will be done that will remove all the impediments to restore this, supply-demand imbalance. Like, everything is good, but, I use this analogy of a car. And car's got four wheels, got an engine, steering wheel, brakes, and accelerator, like all these other little parts. But if you're missing one of them, your car's not going to go. So we can talk about, well, interest rates are too high, construction costs are too high, entitlements take too long. So let's say we fix one of those, doesn't work, right? Even if they removed, like the government gave us the land for free, we don't have enough labor in the country to build the capacity that's required. So anyway, the reason I go down that explanation is to say, I think you get behind a good idea, and I think supplying housing to Canadians is a good idea for a whole bunch of reasons. But as an investment thesis, I think it's a solid one. The second thing is that I do believe that we're in a period of time where housing affordability is going to be a real challenge to buy, and that rental is certainly resurgent and will continue to surge. So I think that that's actually a positive for us as well. We've shown that you can like outperform. Real estate in many ways is a leverage bet on inflation, right? Because you get to borrow long-term money, and we have leases that, essentially people come and go, but you get a chance to reset your rent. So, I wouldn't say immune to inflation, but inflation tends to be a tailwind and not a headwind to our business. And I think if we're talking about a macro environment, which everything except one thing points to an inflationary decade ahead. The only thing that gives me pause on how much inflation there's going to be is this whole idea of AGI, right, or AI. And could that cause deflation? I spent tons of time on these like random walk through theory, but could that result in a whole bunch of people losing their jobs, which means we have disinflation? It's possible, but if you look at what they did during COVID, they print the money to make that up, so that's ultimately inflationary. So even like no one knows exactly the future, but I think it's great if you can be in an investment product like ours that has the right macro thesis, but also benefits from those pro-cyclical inflation story.
Well, correct me if I'm wrong, like in kind of layman's terms, Greg, I think like in real time on any given year, one is buying, when they buy into Centurion, essentially a proportionate chunk of their fair share of the rental income off of the assets. So they're buying into a cash flowing asset.
Yeah.
It's not a theory. It's not, kind of off theoretical. People can drive up to these buildings, look at them, feel the bricks and mortar, and they're participating on that cash rental yield. And then, but also, when we capitalize on the fact that this asset is going to essentially go up in value over an extended period of time, I think even if we're quote unquote in check on inflation, these assets, even if real estate in theory is growing at 2 to 3% every single year, these assets are going to grow with it. And so we're not only participating on the cash flow, but we're also participating in that hard asset. So now if we're in a hyperinflationary period, or even,
well, I'm not saying hyperinflationary, but a period of higher than normal inflation.
Fair. Sorry, I injected a wrong word in there. My apologies. But in essence, like we've got something that's going to kind of be a stabilizer in one's portfolio. Is that is that my understanding of what you've just shared with us?
I think that is right. I mean, one of the core things I talk about in this business is, and it really became like I have talked about this for 2 decades now. But one of the things that people really only understood came during COVID, when we talked about, because a lot of people thought when they talk about real estate, they think that, real estate there's one real estate market. And I said, there's no such thing as a homogenous real estate market, in a similar way that there's a homogenous stock market. Right. There's everyone needs a place to live. That demand has, that doesn't change, right? Everyone needs a place to live, but no one necessarily needs your office building, right? And no one necessarily needs your resort or your industrial building or your retail plaza. So I think, fundamentally, we're a product that I think has less economic volatility and variability than a lot of other businesses.
It sounds boring, Greg.
I think boring is good. I don't say I have a boring job, but to the extent that it's possible, I like investors to think that we're boring.
Fair. And you know what? If you look at the trend of how you guys have performed over the years, steady as she goes. I always say to people, as it relates to your investment or inside Centurion or even some similar asset managers, if you're looking for high octane returns, this is not the place to look for it. If you're looking for steady as she goes, kind of dependable year over year returns. Obviously, I'm not making individual suitability statements, but rather comments on Centurion in general. It's a great place to invest.
Yeah, I mean, we've had some exceptional years, where we've posted 20%, and I think a lot of people would be very happy with those type of numbers. But I've never promised that, right? I've always said, look, 7 to 12. Sometimes we're going to outperform that. Historically, we have. Our 15-year track record on this fund is north of that range.
Right.
All I can say is we try to be conservative, try to, without taking a lot of undue risk, achieve that and hopefully do better. I think all the keys are there for us to do that in the future.
So, Greg, I'm wondering if I've got kind of two more questions for you as we wrap up. The last question, or second last question I want to ask you is really around kind of, I'm personally a little bit bullish on where I believe that Centurion can go. And at the time of this recording, we're in the spring of 2024, and we're kind of, I think, in my seat, that there are some exciting things right now in the pipeline or tailwinds for Centurion. What comments, or obviously you're not a GIC, but what kind of commentary might you add of why someone would want to jump in right now? Why would somebody get excited about being a Centurion investor today?
Look, I think, one of the things that I've been more than fairly critical of our central bank and our politicians, and that this hiking campaign was actually going to be pro-inflationary. Now, aside from the fact that we're the only central bank in the world that measures inflation, and by we increase interest rates on the mortgages, so that's inflationary. Okay, we're the only central bank country in the world that does that. But I noticed, and I said this would be the case, and I pointed this out on subsequent charts. So we tracked something called the market rent gap, right? So this is the difference between market rents today, which are accelerating still extraordinarily quickly, and the rents that are being charged to residents, right? And I said, market rents are going to explode, and that would be inflationary. And why was that going to happen? Well, if you make it more expensive for developers to build, well, guess what? They're not going to build, right? So supply is going to go down. If you're going to make it so expensive that people can't afford to buy, so they're not going to buy those condos. And to get a condo built today, you need 80% pre-sales. So if you can't, a developer can't afford to build it and someone can't afford to buy it, well, guess what? All those people are now going to get forced into rental, and that's exactly what we've seen. So if you look at a chart, and we publish this quarterly, and you look at our market rent gap, absolutely exploded the first quarter that they started hiking rates, and that's exactly what we said would happen. So today we sit at the largest gap we've ever seen in our history. So we're at about 41 million of market rent gap, which at today's capitalization rates is worth just short of $1 billion. Wow. In market value. For us to, and what we have to do over time is to realize that, of course, but we've got a pretty good track record of realizing that over time. So there's a lot of what I would call gas in the tank. The other thing is, we believe coming into the fall, once the interest rates start getting cut, you know, we've had a business where, you know, our focus for the last number of years has really been on the new construction apartments. And so we're kind of an earlier investor in this spot. And we have a business where we help finance developers. So debt and equity financing, we can lease it up, we can manage, kind of do the whole spectrum. So we've talked about, you know, for this country needing $3 or $4 trillion of housing, call it a third of that is apartments. So $1 trillion of apartments need to be built over the next 10 years. Make no mistake, we're not building anywhere near that number as a country, like not even close, right? But the opportunity set for us, not only on the portfolio that exists, but on the opportunity to create all this new housing, given how we've positioned the organization, I think is fantastic. So we're really excited about everything and on those fronts.
What a great news story. And certainly, as I think, you know, you guys have always maintained a wonderful third party evaluation structure.
Yeah.
And you know what, when assets are marked to market value as interest rates come down, I think there's also some tailwinds there as well, where your evaluators at due time can, I certainly see some really positive potential evaluations in the coming 12 to 24 months.
I think that that's true. I mean, cap rates went up last year, not as much as rates, but they did go up. Part of the reason why, like, people have this view that they move one for one, and they don't, because the rent inflation has been much higher than the interest rate inflation. So, you know, if not for the raise in cap rates last year, like that, the value of that was about $250 million, right? So if we'd not seen cap rates go up last year, you know, our returns would have been mid-teens, right? You know, we also make practice to borrow long term, right? So, but we don't mark up the value of those mortgages. So last year we ran it in the beginning of the fourth quarter, and if we had marked our mortgage liability book up, that would have been $330 million of positive NPV, which we didn't mark, but we marked the assets down by the cap rate. So I think we're very conservatively positioned for the next couple of years. And you know, what I would say is, it certainly, in my opinion, you know, we're spring loaded for, you know, the turn in the market.
I love it. I'm going to put that in quotations. Spring loaded. I love it. Greg, last question then to you. And,
sure.
Is just as we wrap up, if there's anything else that you wanted to highlight with the question of why Centurion? Why should a client invest and trust you with their money? Why Centurion?
Like, I think we've been doing this a long time. You know, I think we've proven ourselves to be able to deliver low volatility returns. You look at our track record, we published this, you know, the risk return matrix, and, you know, we're top left, right? With a third of the volatility, you know, and it's been steady Eddie, consistent growth, and never a losing year. I'm not saying that that's ever, you know, not like I can't make that representation, but, you know, I think we've been able to deliver, and I think we'll continue to deliver, and not in something that is very hard to understand. I think in many ways, you know, I can describe what we do in less than 2 minutes, and I think most people can understand what we do in less than 2 minutes. And, you know, there's a lot of really funky investments out there. Very few of them are actually understandable. You know, so I think that, you know, we'll continue to deliver for a portion of investors' portfolio, not only, you know, without taking an undue amount of risk, but I think we help for that particularly for people who are a little bit concerned about being in an inflationary environment where they have very little control over, their ability to hedge that. And I think that's something we can help with.
Greg, thank you for being a part of today. It's such a privilege always to rub shoulders with you. Great to have you.
Thank you. I enjoyed being here.
As always, my door is open. Until next time on Money Match, thanks for joining us.